Hello, I'm Paul Jennings. Welcome to this video on the Conceptual Framework for Financial Reporting. I will talk about three key ideas in the Conceptual Framework. 1. What is the objective of financial reporting? 2. How do we decide what makes information good quality? And 3. The elements of financial reporting, the categories that we use to formalise and standardise our reporting of business performance. In this video, I'll talk about the third of those three key ideas, the elements of financial reporting, the categories that we use to formalise and standardise our reporting of business performance and position. The conceptual framework identifies the elements of financial statements. The elements of financial statements being the type of phenomena that can be represented when we want to tell the story of the business. In order to be included in financial statements, information must meet the defining characteristics of one of these elements: assets, liabilities, equity, income, and expenses. And we must all agree on what makes something, for example, an asset, so that we share a common understanding of the terminology used in financial statements. Let's start with assets, because that's where we find the value in our business. Assets are resources. Resources controlled by the business in such a way that they can be used by the business to generate profits. More formally, in the conceptual framework, an asset is defined as a present economic resource controlled by the business. And an economic resource is itself defined as a right that has the potential to produce economic benefits. What these formal definitions show us is that assets, which we might describe informally as things of value, are really rights. And rights are valuable because they allow us to make money. The right to occupy a building, a factory or a retail outlet. The right to use a machine which we've bought or rented. The right to exploit a trademark and the right to stop anyone else exploiting it. The business benefits from its rights to use these resources to generate profits for shareholders. And now we can see the duality of accounting here. The business has acquired those resources by spending money, and where has that money come from? From the company's owners, its shareholders, and from external lenders, usually bondholders or banks, but really anyone who's prepared to invest money in the company in one way or another in the hope of generating a return. Sources of finance are described as equity, if we're talking about shareholders of the business investing their own money, and liabilities if we're talking about external lenders, money that the business has an unavoidable obligation to repay. So we can think about energy flowing around the business. Sources of finance, equity and liabilities, are used to create assets, resources which the business will use to make profits, which they will then return to the sources of finance, shareholders and lenders. The distinction between equity and liabilities is important. Equity represents the owner's investment and any profits which have been accumulated. Liabilities are obligations, any obligations to outsiders. They might be obviously money-based, the obligation to repay a bank loan or to make an interest payment on a bond, but liabilities also describe our other obligations, such as an agreement to supply goods or services to a customer. We also need to be able to capture how the business's financial position changes from one moment in time to another, how assets, liabilities and equity change. Income and expenses are a way of capturing those changes. Income means improvements in financial position, so increases in assets or decreases in liabilities. And expense means deterioration in financial position, so decreases in assets or increases in liabilities. Our financial statements will show the financial position of a business at a moment in time, a snapshot of its assets and liabilities and equity, and will also show the financial performance of a business over a period of time, its income and its expenses, or how its assets and liabilities and equity have changed, the extent to which the financial position has improved or deteriorated. So firstly, we identified our overall objective: to provide high quality information about the financial position and financial performance of a business to actual and potential shareholders and lenders. And secondly, we defined what we mean by high quality information in terms of what are the characteristics of good information. Thirdly, we identified the elements of financial statements, the building blocks that we use to produce financial statements that are standardized and therefore widely accepted by users.